Well, good afternoon. Welcome to the October 2022 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, October 20th, 2022, and the time is 1:05 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel. Start the meeting by calling the roll. Gregory Faulkner.
Present.
John Marich.
Present.
All right. Russell Buckley.
Hi, Antonio. I'm present for Chancellor Banks. CFO is Rita Scott.
Allison Hirsch.
Hi, Allison Hirsch, present for Controller Brad Lander.
We have a quorum. I'd also like to note for the record that alternate Executive Committee member John Dorsett is also in attendance. The first item of business is to consider the minutes from the September 2022 Executive Committee meeting, a summary of which was included in your packets. May I have a motion to consider the minutes?
Move Russ.
Thank you. Second?
Second from John.
Thank you, John. Any discussion or any questions on the minutes?
None for me.
All right. All those in favor of approving the September 2022 Executive Committee minutes, please say aye.
Aye.
Russ.
Aye.
Any opposed? Any abstentions? The motion carries. The next item on our agenda is a presentation from the Office of Corporate Governance of the New York City Comptroller's Bureau of Asset Management for the fiscal year 2023 Fall Proxy Committee and Shareholder Plan presentation. With us today, we have Jennifer Konovich from the Office of the Comptroller. May I have a motion to consider the presentation?
So moved. Russ.
Thank you. May I have a second?
Second from John.
Thank you, John. Jennifer, I will share your presentation and then the floor is yours.
Thank you so much. We're happy to come to before you today with a recommended 2023 shareholder proposal program. And is it up, Antonio?
It is.
Okay, hold on a moment. I'm not seeing it. Okay, perfect. Okay, I think we're ready for the first page.
Okay.
In the climate arena, as part of our efforts to address climate-related financial risks, we recommend focusing on banks' financed emissions and continuing to focus on carbon-intensive electric utilities and reducing their GHG emissions. So in the first instance, which is what we're looking at right here, we understand that not all large North American banks have set interim absolute GHG emission reduction targets for the energy sector. Many banks have set intensity targets. However, these intensity targets won't capture whether their total financed GHG emissions have decreased in the real world. So we're recommending that we request disclosure of absolute targets at the banks that don't yet have them. And if you look at the bottom of the page, you'll see that Citigroup, Wells Fargo, and HBC already have them. So the focus companies are those that don't. And you can see that's Bank of America, Goldman Sachs, JP Morgan, Morgan Stanley, and Royal Bank of Canada. I just am also noting that these targets will be in addition to any emission intensity targets for the energy sector that the company already has or will set. Next slide. We, in addition, will continue our focus on utilities, and we already engaged with Southern. It's the fourth highest GHG emitting electric utility in the US. It looks like they have or will reach their 50% reduction targets for 2030. Here, we're looking for Southern to be a bit more ambitious, and we're seeking further disclosure of their GHG targets aligned with the Paris Agreement. I want to here note that other shareholder proposal proponents intend to refile proposals calling on banks to stop financing new fossil fuel projects. And in 2022, so this year, we came to BERS and you approved voting your shares in favor of these proposals. We expect to vote the same way again this year when these proposals are refiled. Next slide. This is a topic near and dear to our hearts, I assume yours as well, which is trying to address the issue of anti-union activity at various large companies. So the world splits sort of into two parts. One is there are companies that have committed to respect workers' rights to freedom of association and collective bargaining, but have actively interfered when their employees have sought to form a union in violation, we believe, of their own policies. Then there are companies that have not yet adopted a policy. So what we propose to do is on the companies that do have a policy and have behaved badly or in violation of their own stated policies, we'd like the board to oversee an independent assessment of the company's adherence to their stated policies. In the instance of companies that don't have a policy, we'd like them to adopt one. Next page will show you the companies. So for those that do have policies, in the case of Apple and Starbucks, we came to you really at the end of the summer about this topic because there were early filing deadlines. So you approved, and we've already filed proposals at Apple and Starbucks. We'd like to go forward and file proposals at CVS Health and Walmart. Amazon is listed as tentative because you may recall that we have a focus on their board members in particular. We think that there is a failure of board oversight in the human capital management arena, including on these issues. Last year, we did a vote no campaign. We're thinking of what the appropriate strategy will be here this year. Chances are it won't be a shareholder proposal. Amazon gets more than almost all other companies. They're not typically successful. We don't think it would be be particularly effective here, but we'd like the authority just in case it does make sense. In the policy context, again, companies that don't have a policy, we'd like to file at DoorDash and Netflix. Just noting that DoorDash has a large number of not only white-collar tech jobs, but also independent contractors. We'll see if we can find a way, if feasible, to include independent contractors as well. Final note on this topic, Chipotle appears on both lists because we don't yet know if they have already made a commitment to freedom of association. Next page. Employers have long used arbitration clauses and NDAs to stop employees from talking about their experiences with the employer in connection with alleged discrimination or perhaps other labor law violations. In this arena, the legal landscape is changing. There have been some state laws in this area concerning prohibitions of NDAs. There's been some recent federal legislation concerning aspects of use of arbitration clauses. So it's not set yet, but we would pursue one of two approaches, either asking the company to report on their use of concealment clauses or perhaps prohibit them in certain contexts. The two focus companies here are interesting. Pinterest recently announced, I think in 2021, a resolution of a lawsuit, allegations of discrimination against women and people of color. They pledged $50 million to overhaul their corporate culture. They also had a very large settlement, $22 million, to settle gender discrimination lawsuit brought by a former COO. I believe that was in 2020. Wells Fargo, in the category if you can't make it up, is under investigation. I don't know if it's current or not, what the resolution is there, but the allegation was a violation of anti-discrimination laws for conducting sham interviews of Black women and other underrepresented groups. And the CEO also apologized separately for making statements that allegedly disparaged the Black talent pool. Next page. Board diversity disclosure has been an area in which we've been a pioneer, the New York City systems, that is, for a number of years. And we'd like to continue on with this really long-term initiative, hoping to make change over the long term. And I think that we have a chance of really doing so. The board matrix proposal is really a fancy way of saying that we're asking companies to disclose the self-identified gender and race and ethnicity of directors or director nominees and their relevant skills. Without that, it's difficult for investors using aggregate and ambiguous company disclosures to determine the board composition of various companies. The target companies here really fall into two categories. We're looking at two different industries. One is hotel and restaurants. They were particularly hard hit by the pandemic and have a lot of frontline workers. And then the second industry is the airlines, and they have a diverse workforce by type of worker. Okay, next slide. Here you can just see a list of the focus companies in these two sectors, just noting that NYCBERS is a refile from last year where we filed this proposal. Next slide. EEO disclosure is something you've also heard about for quite a while. This is a long-term, wildly successful campaign that New York City really gets tremendous credit for undertaking, which is to get companies to disclose their EEO reports publicly. They already provide them to the government. When we started our initiative, I think 14 out of the S&P 500 disclosed or committed to disclose. We're now at over 90 S&P 100 companies. Here, what we're looking to do is push past the S&P 100 to the S&P 500, where quite a number have already committed or are disclosing. But we're looking at two that, at least to our knowledge, or have not, and that's Domino's and Kohl's Corporation. Next page. This is what we would think of as a really mom and apple pie corporate governance initiative about independence of the board chair. Here, we'd like to request that Wendy's name a board chair that is independent of both the company and its largest shareholder, Trian Partners, which is the hedge fund led by Nelson Peltz. The goal here is really twofold. One, to continue to make it clear to the company that they have been unresponsive to our requests and other investors' requests to join the Fair Food Program, which is, this request has been ongoing for years. They're an outlier among other of their peers. And also to strengthen the independence of the board when we know that the chair has expressed some interest in buying the company. Next page. Finally, this is an update. This is an initiative that has already been approved by BERS. We came to you, I think, again, late in the summer because of filing deadlines. This is about an application to the independent international standards organization to establish a merchant category code for standalone gun and ammunition stores. You may recall that these MCC codes can be used once they're established by banks and perhaps in payment networks to flag suspicious purchases that may be associated with illegal activities such as gun trafficking or perhaps mass shootings. After we filed these proposals, we filed at MasterCard and Amex. We sent a letter to Visa because their filing deadline had already passed. Quite a bit of attention was brought to the issue just before ISO took up the application. We can't say precisely what the credit cards didn't do, but we can say that they were not the impediment, and the ISO adopted the MCC codes, I think in large measure because of the attention that was brought to bear on this issue, or at least in part because of it. And we continue to discuss with the credit card companies, or at least some of them, their implementation of these codes and an engagement. So that's the update on that issue. And that really concludes the plan for the year. And we hope that you will accept these recommendations.
Thank you, Jennifer. Any questions for Jennifer or the team from the Comptroller's Office? Donald.
Yeah, so good afternoon, everyone. My question here, of course, morally, I look at this and say these are the right things to do. But I guess my question here is, how much leverage do we actually hold in these situations? Because for me, I hear that some of the companies in the presentation and some of the companies were unresponsive. So how much leverage do we actually have here? Because for me, I would rather not make just a political statement with no path to actually forcing these companies to implement some of these policies.
Oh, that's a very good question. It's really part of a bigger piece of corporate engagement with portfolio companies. I am doing this by memory, and I could be inaccurate, but I think something like 85% of our proposals last year actually resulted in essence, a negotiated resolution. So in other words, we filed the proposal, and then the company engages with us. We discuss the issue, we negotiate, and it may lead to a negotiated withdrawal, which means that in essence, we've had success. We may not have gotten everything that's in the proposal, but we've made strides. And so I think that in the bigger scheme of things are actually quite effective. Any one proposal may not be, but the program itself is quite effective.
Okay, thank you. Yeah, code to the submitted games does pretty well. So, thank you for that. That was just my thing. Versus making a political statement, we're getting somewhere. We're pushing these companies to do this on the morally correct things. So I'm fine. Thank you.
Hey, Donald. Russ?
Thank you, Antonio. Hi, Jennifer. Russell Buckley from the Department of Education. I was curious, I had a couple questions on some of the climate proposals that you had discussed on both of the financed emissions and then also on Southern Company. I was curious if that engagement was being conducted in alignment with Climate Action 100 or any other external groups that you were coordinating those actions with.
Southern is being conducted through Climate Action 100. That engagement, and it's been ongoing for a number of years. This proposal is not yet set. With respect to Southern, it's not set that we would do it. We're in discussions with Illinois about the possibility of co-filing with them on this.
Got it. And then the financed emissions banks?
The financed emissions, we are part of Climate Action 100, and they're aware of this, these bank proposals without doubt. We're not the lead in terms of engaging with banks separately through Climate Action 100, as we are in some of the other companies like Ford or GM. And we have talked to other stakeholders about these proposals.
Great, thank you. And I guess with regard to some of the prior proposals and initiatives that have been taken by your office, is there when should we expect the postseason report?
Oh, that is being actively worked upon. As soon as it's ready, it will come to you for review and comment.
So within the next month or so?
I don't want to say because I'm not absolutely certain, and I would like to think so, but I can't say that with certainty. But it has, I believe it's put out publicly before the end of the year. So it will be happening, I would assume in short order.
For the end of the year. Got
Yeah.
it. Thank you.
Jennifer, I actually had one question. This is with regard to the banks in particular. Two of the names on the list actually manage money for BERS, and so wanted to know to what extent have do the asset manager, I know your office and Mike and his team keep track of how our managers are voting on proxy on shareholder resolutions and the like, even if they're not voting for us. Any thoughts on that as you guys are thinking about it? Because two of the I think the four banks manage money for BERS.
Yes, correct. We are aware of that. We have not, I don't want to go beyond what I know, because I don't know if there were, other discussions that I wasn't aware of. But, I think we're treating it as a separate engagement. In other words, it's not like we'll be on the phone and discussing, their management of our funds or their stewardship of our funds, and how they're handling their role with respect to that. This will be on a separate track.
Can I just jump in on this though? So we are, and this is part of the net zero 2040 plan that we'll be discussing with board members next week and then bringing to the full board. We are beginning to engage our asset managers and how they are voting for, even though we do our own voting for the rest of their portfolio in these instances. And that was sort of a piece of the genesis of the letter that the controller wrote to BlackRock, was because their voting record last year was on climate issues in particular was much worse than it had been the year before and was a clear sign of the backtracking that they're doing through their rhetoric. So I think there's going to be moving forward a more sort of strategic approach to engaging our own money managers in how they vote and engage, even as we are trying to change their behavior on their other, like on their banking side and finance side.
Okay, thank you. Thank you.
Allison, that's very helpful because of course that'll be extremely important for us to meet our own goals that our managers are setting their own goals and pursuing them.
So, any other questions from the board for Jennifer and the BAM team? All right. All right. Hearing none. Oh, before I go to the resolution, just note for the record that Donald Nesbitt is in attendance. So the recommendation is to approve the fiscal year 2023 shareholder plan as presented by the Comptroller's Office. Do I have a motion to approve the recommendation?
So moved, Russ.
Thank you, Russ. May I have a second?
Second from John.
Thank you, John. Any further discussion? All right. All those in favor, please say aye.
Aye,
John.
Russ.
Hi, Allison.
Any opposed? Any abstentions? Motion carries. Thank you. The next item on our agenda is for discussion, the Q1 fiscal year 2023 preliminary performance presentation. So I will share my screen. Item is strictly for discussion. So when folks were already at this is again, all these numbers are as of 9/30/22. All right, and so folks who are at the full board meeting saw these numbers. So we won't spend too much time on them. Fiscal year to date, down 4.25% preliminarily. If folks who were at the meeting yesterday, the joint meeting with NYCBERS, saw that as of October 14th, our portfolio is down closer to 4.5%. We are still above our target for the trailing 6 years at 7.62%, beating the reference portfolio and global reference portfolio as well as the policy PME benchmark. We will talk more about the active managers, and Mark will talk about that momentarily. I actually wanted to talk a little bit about benchmarking today, and you've seen this slide a number of times. The 3 different benchmarks we use when we're discussing performance. And what I really want to talk about is the differences between these benchmarks and some of the other benchmarks you see, and why I think it's important to look both at the policy portfolio benchmark as well as other reference portfolio benchmarks. Benchmarking, I think, has multiple purposes, and sometimes the purposes for review for the board and for staff are different. So, for instance, when I think about how the board, if I was sitting in your seat, I sat in your seat for 4 years prior to coming over to BERS, how I thought about benchmarks. And one of the big things is I didn't want to assume, and I don't think we should assume, that we got asset allocation right? Staff, the folks at the Bureau of Asset Management, they have to assume that you got asset allocation right. Asset allocation is in the purview of the board, and so their job is to implement the asset allocation that the board passes. But when we're looking at our decision making, did the board actually get asset allocation right? Were there ways that we could have allocated differently within reason that would have been better for our outcomes? Other things we have to consider is added complexity worth the cost? And I'll talk about that a little bit more in a second. But ultimately, we can run a very simple and cheap portfolio, or we could run a complex and expensive portfolio. Running a complex and expensive portfolio on a net basis should outperform if we're going to continue to do that. What are our opportunity costs? Again, that goes right in line to our asset allocation. Could we have invested in a different asset class or a different strategy that would have both given us a better outcome while maintaining the risk that we want to maintain? And how has diversification helped and hurt us? I think staff really has to think about, is each program in their asset class meeting expectations? So is the infrastructure program meeting its expectations? Is real estate meeting its expectation? Each of the asset class heads really have to, that's what they consider. And as the board, sometimes those benchmarks may or may not work as well for the larger asset allocation decisions. We have to think about, did they pick the right managers, and should we add or reduce the number of sub strategies? So I want to really kind of hone in on this to just give you the why I think it's so important to use the reference portfolios and policy PME portfolios in addition to the general policy portfolio benchmark that you'll see in the State Street report. So the U.S. reference portfolio, my estimates, and that's again only U.S. equity, only U.S. fixed income passive. I think we could probably run that portfolio for something like $1.5 million, given our current costs. The global reference portfolio, estimated about $9 million. Policy PME portfolio, which substitutes alternatives for their public market equivalent, my estimate is that we could run that for $14 million. Versus actual full portfolio with alternatives was $8 million in the previous fiscal year. So when we're thinking about implementation, you hope that that $58 million is worth it. And if you saw the slides both yesterday or at the full board meeting, that complexity has added value to the portfolio. But I think keeping that in mind is really important as we're thinking about benchmarking. And while I believe looking at multiple benchmarks is important as we're planning for the future. One other thing just to highlight really quickly is that there's nowhere to hide right now. You see right here, fiscal year to date, all six of our major markets are down over the trailing year, somewhere between 12 and 30% for the fiscal year to date. Only, and this is as of 10/19 benchmark returns. Only high yield bonds have a positive return, and that again is 20 basis points. On the far right column, you see over and over again the same story we've been telling. U.S. equity, almost 12% annualized for 10 years. Everything else, pretty much second best. And in fact, U.S. high yield has done better than the other two equity markets. Core fixed income has not returned well over the past year. Really hasn't even added much as far as from a risk mitigation standpoint. One thing I thought that was really, really helpful during CIO Steve Meyer's presentation last month was highlighting attribution analysis, and he talked about the allocation and selection effect. It has been something that has been historically overlooked in our performance discussion, and mostly to look at kind of the returns against the benchmark. But I think attribution analysis is incredibly important. It helps to illuminate how decisions and implementation affect our outcomes. At the end of the day, we have no control over the macro environment. We do have control over how we implement and deviations from the policy portfolio. The allocation effect, I think, is particularly important. It compares how deviations from the strategic allocation affect portfolio returns. And so I want to take it because I know some folks have been on the board for quite some time. Some folks have not been. And so when Steve talked about the allocation and selection effect at the board meeting, I want to make sure everybody knew kind of the definitions of them. So further presentations, you'll get a good idea about how how they're calculated and how they ultimately affect our outcomes and how we judge outcomes. So the allocation effect is this is my definition, but a portion of excess return that's attributable to the deviations from strategic asset allocation, the target or the policy portfolio. So if you have an excess return number, how much of that is because you were in your overweight assets that did well or underweight assets that did poorly? The selection effect is the portion of the excess return attributable to the fund selection and weighting decision. So the managers within each of the asset classes and how we weighted the managers that did well versus the managers that did poorly within those with those funds within those asset classes. So that's really the difference between the two. And why I think focusing really on the allocation effect is because the board sets policy on sets policy for asset allocation. And so that is the board's policy by which deviations are owned, in this case by staff. But selection effects, again, manager recommendations come from staff, the Bureau of Asset Management, and so that really is the parts that again the recommendations come to you all, but you're not proactive in setting those guidelines. So if you follow the State Street reports, you'll see that there's actually two different policy portfolios within the report, the large State Street reports. There's the policy portfolio, also called the new policy portfolio, and then the adjusted policy portfolio. I want to talk a little bit about those differences because those differences will actually have a pretty large effect on the differences in the measured allocation and selection effects. So the policy portfolio is the target asset allocations the board passed in 2020. Importantly, it assumes that uncommitted and uncalled private market capital is an implementation choice, so that it is part of it is tactical rather than strategic. And so we do not so we assume that if we're underweight a asset class, or we're underweight a private market asset class, that's an implementation choice. Because that's the case, it tends to increase the portfolio allocation effect. So that means that you'll have a larger allocation effect if you use a policy portfolio to measure the allocation and selection effect. I believe that it's more accurate, and I put accurate in quotation marks because, again, people can rightly defer on which one to use. But I think that it's more accurate with mature private market programs. So a private market program that you've had for some time, have had the opportunity to get to target, it'll be more accurate for those programs, because after a full cycle, there are different ways that you can get to target. We don't have control over when managers call capital, but the board does control how much committed capital per year goes out during the annual plans. So from that perspective, after a program's mature for some time or has had time to grow, I do think that using the policy portfolio gives a more accurate measure of the allocation effect. The adjusted policy portfolio assumes that the current private market allocation is the target private market allocation. So for instance, if currently we're at 7% in private equity or 2% in infrastructure, it assumes that that's our target. And the thought process behind it, again, is it takes time to ramp up the allocation to full target. The individual funds, retirement systems do not have control over when managers call capital. So that assumption says that because it's not necessarily in our control, that it allows that essentially should not be hurt or helped by it in the measurement of the allocation effect. Uncommitted and uncalled private market capital is then added to the public market target. So what it does when we are overweight a private market is that it reduces the target for the public market. So for instance, we are overweight private equity right now by about 2%. It takes that 2% from the US equity. So our adjusted target right now is 29% instead of 31%. It tends to reduce the portfolio allocation effect over time because it assumes that we are at target at all times. That means none of the deviations can come from the fact that we're not at target. I believe that it's more accurate with less mature private market programs. So for instance, our OFI or private credit program is one where we started it only 2 years ago, and so have not had time to ramp it up to its full 5% allocation. And so for a program like that, I do think that the adjusted policy portfolio typically makes more sense because we have not had time to get to the full allocation. And within the state sheet reports, when you see the allocation selection effect, they use the adjusted policy portfolio. If you were to log into the CAISA platform, you will get the full policy portfolio. So what you're going to see, you'll see this here, is that the allocation effect seems to be a lot larger than what you'll see in the state sheet reports. Now, conversely, the selection effect actually is much better in CAISA than it is in the state tree reports. And that's for a few reasons. I think the biggest reason there is that some of the customized benchmarking that State Street uses, particularly for our international, are not available to put into the CAISA platform. So if you log in there, you'll see a difference, again, typically a lower allocation effect, but a higher selection effect. And so how this actually works in practice. The allocation effect over the 3 years ended 6/30/2022. Again, this is using the policy portfolio, not the adjusted policy portfolio. Bubbles on the right are things that we are overweight. Bubbles on the left are things that are underweight over that entire 3-year period. So not just at a point in time, but on average over the 3-year period where we're overweight or underweight. So from an allocation effect perspective, the biggest the most additive allocation effect was that we were underweight OFI private credit for that time. That added 6 basis points annualized over those 3 years. That's invested in, because we're invested in equities, right? I think that's really it. Like that leftover money was in U.S. and developed market equities, which over the time period outperformed OFI. U.S. equity overweight also helped at 3 basis points. It was the highest returning by far in the public market asset classes. High yield, we were underweight, and again, that was mostly invested in equities during the underweight, and so that adds 2 basis points. By far, I think the largest detractor was being underweight private equity through the run-up. Obviously, we'll see how that works out now as valuations are coming down. But the 3 years ended at the last fiscal year. That was private equity was by far the highest returning asset class during that time period. So being underweight private equity on average cost the system. Core fixed income and cash. Core fixed income is a parking place for real assets, and so we had been strictly underweight the real assets. And so core fixed income, as you saw, returned under 1% for the 10 years. So really, and over that 3-year time period, so it cost quite a bit. And then the cash overweight, that over time we're a bit overweight cash. We have a zero policy for cash, so being overweight cash at any point in time will be a drag on the effect. But again, this was more to kind of talk about it because it's going to be a feature of the BAM's quarterly presentations going forward. Understanding what allocation effect is, understanding what the selection effect is, and how it's calculated, and the different ways that it can be measured within different reports, I think is important as you all are thinking about the utilizing it in your analysis. So I'm going to turn it over to first Vanessa and then Salil. But one thing I wanted to make sure to set up Salil's presentation in particular is that we have a lot of decisions around asset allocation in the policy portfolio in the coming months. Major financial markets are down 10 to 30% over the previous year. There's nowhere to hide right now. So we want to prepare the committee for decisions that are related to those following topics. So our funded ratio, the TDA leverage effect, capital market assumptions, and the role and use of active management, which again, implicitly, Vanessa will talk about in a second. And then Salil will go through in his update to the long bear market discussion. So before I turn it over to Vanessa to talk about the active manager heat map, are there any questions? None.
I'm good, Antonio.
All right. Hearing none, let me.
Yeah, while Antonio puts up the presentation, the few slides, I just wanted to let the board know that Ben Hall, which is a vice president in our research group, is with me today, as well as Sean Hunt, which is an analyst in our research group, and they're available to answer any specific questions on any of the active managers. Did you find this slide, Antonio?
Right, let's see, should be good to go. 1 second. Let me know when you are. Yeah, do you all see the?
Yes, I can see it. Let's go to the next slide.
Okay.
So
right, I'll zoom in a bit.
Yeah, there you go. So as Antonio mentioned, there hasn't been any place to hide. These are the returns of your manager minus the benchmarks that are used in the State Street report. But it is updated through September 30th using CAISA. You will see here the allocation column shows what is the allocation to active management. Anything that is not allocated to active management is with a passive strategy or an index fund. So yeah, as Antonio mentioned, the performance has been really bad this year. And it's been across US equity, developed, and emerging market. I mean, we've all heard about inflation concerns. We've heard about tightening monetary policy, not only in the US, but also across the world. And that has really hurt some of your managers. Fixed income has also declined. And these are some of your active fixed income strategies that have declined. Anything that you see green on a year-to-date basis doesn't mean that the performance is positive. It just means that they protected capital versus the benchmark. So they have lost capital, but a little bit less than the benchmark on a year-to-date basis. What we're seeing is that really with the bad numbers in the year-to-date calendar period, and some of your active managers also having underperformance last year, it has really trickled down into the 3, 5, and 7 time periods that you have here, more longer terms. Now, we still like all of your active managers, so there's no recommendation to terminate. As you know, that we are currently reviewing your non-US developed managers in the RFP, and in discussions with BAM, we think that we're going to be ready to come to, or they're going to be ready to come to the trustees for the first meeting next year. At least that's the estimate timeline that they've given us. But yeah, it's really, first of all, I apologize for all the negative performance because, it's really hurtful to see the numbers and to see so much red in a page, but we're available to answer any specific questions that you may have.
All right, any questions for Vanessa or Ben?
Just wanted to follow up on something you just said, Vanessa. You said that BAM is doing a search for emerging market active managers. That's developed, so that's non-US on this slide.
Non-US. Yes. So
Okay.
when you look at the slide on the managers, it's really Bailey Gifford, Spruce Grove, Acadian, and Alger. Those would be the managers that are currently in an active RFP. If you recall, I believe the search actually started in 2021.
Yep. Yep.
Thank you.
Yeah.
All right. Well, any other questions for Vanessa, Ben, and the Siegel Marco team?
Thanks, Antonio. I got one. Vanessa, do we know if they are evaluating index alternatives for some of these allocations as opposed to active management?
I introduced that discussion and I said that I would like to see options with passive management also as part of the portfolio construction.
Thank you.
Perfect. Well, last time, any questions for any final questions for the Siegel team? All right. And then thank you, Vanessa. Thank you, Ben. So the last item for public session, and Salil, I don't know if you wanted to share your screen, but this is an update to a previous presentation that Salil gave. Salil, again, is our Deputy Director of Investment Strategy on bear markets. And so I would love, Salil, the floor is yours for your update. Looking forward to it.
Thank you. Are people able to see my PowerPoint?
Yes.
Okay, great. So as Antonio mentioned, this is an update to the bear market analysis, which was a more qualitative discussion that I had 4 months ago at this meeting, and the promise to reiterate some of those points with more quantitative substance during this meeting. And then I also have a little bit on developed market analytics that are seen here. So just a recap of the presentation from a few months ago, and some folks are new, so a benefit for them as well. The comments that were made were that bear markets do come and go. The one we're currently in may not stop simply because it has reached some sort of trigger or level, say 3,600 on the S&P, negative 20%, any sort of markers like that. It's always been prudent risk-taking to be cautious during run-ups and to be able to identify them contemporaneously, and also means considering core asset allocation and consideration of funding in the face of falling return estimates. In our case, in relation to TDA, other liability considerations, things like discount rates, the liability mix, things along those lines. We should consider a larger than assumed set of pathways given uncertainty in the investment process, and also in terms of asset liability management stochastic projections, which always assume a neutral starting point as a baseline. We should know that this is a particular case where we should be conditioned on knowing that we're in a softer economic period and one where we see cyclical economic deterioration. So we should experience asset headwinds and also continued private sector markdowns in the portfolio. And the last point from the previous presentation is that it's clear that when you take increased risk against what are at times impossibly high return targets or imprudently high, it can elevate spurious risk-taking along the investment process, which is things that are not statistically possible. And I'll go through some of that now. I'm a statistician by background, have done this for about 15 years, both academically as well as Wall Street and PPGC and other places. So I come with that perspective in this presentation as well. So first, let's go back in time. Say you're in a time machine, you go back 10 years to 2012. And in blue, we see what were the 10-year forward assumptions on returns for different equities for US developed markets and emerging. You see that for, you might be able to see a cursor perhaps move around the screen. Is that true? Can someone confirm that?
Yes.
Okay, good. So you can see a marker in case I'm trying to point to something. You can see that the assumption was that you'd have somewhere around 7% for US over the last 10 years, and it would be increasingly larger for developed markets and even larger for emerging markets. In reality, we saw these returns here in silver, and you can kind of see this pattern where the promise was for even more, but we got significantly less, about a 5%. I would call that disappointment versus expectations, say in emerging markets. That's around a 2 standard deviation, I'd say disappointment there. And there's this idea that, well, you know, things come back and rebound and so forth. So let's do the same time machine exercise, but go back 20 years to 2002. And you see the same essential jaws formation, a promise for even higher returns across the board, which weren't delivered, but then even more disappointment as well. So that combined with the 10-year chart you saw earlier is close to a 3 standard deviation miss. So this idea that it would be true forecast, but then be off by almost 5 percentage points in some of these geographic asset classes is less than 1% likely. So it's something that has to be known because it's not the fault of anyone. It's just part of the way the theoretical models from the mean variance up through CAPM sort of generate these returns. They return them in such a way that you should be able to identify what the flaws are before making decisions based on that. And here I will show that in blue, I show on the left scale what is the change in funding ratio year to year, fiscal year. And in silver, I show, using the right scale, the change in, I did a 75-25 stock bond split, but it doesn't really matter. I could have done 60-40, I could have done 90-10. The idea is that there's a large amount that's on the risk end of asset classes, and that is a large driver of funding ratio changes in our pension. And it's about a 70% correlation. And you can see here, you can see some of the impacts of actuarial changes along the way, assumptions like in this era here, there was a change that moved from market value based liabilities to something more of assets to more actuarial based, and then it sort of reverted. There was also changes in the way there were mortality changes and other impacts here, which led to a little bit more conservative funding ratio estimates. But what you see is that during periods where you get large drops in the market, in the dot-com period, the global financial crisis, when they're large and sustained and below the threshold that we have here, then you obviously get losses in our funding ratio. So when we say that we don't have the official numbers yet, obviously the actuaries will present this later in their next report, but we know what the losses in the markets have been for the most part over the last 1 year. So you can on a pro forma basis, estimate that your percentage drop in your funding ratio might be around -20. To the degree that you see continued flatness or losses in the markets, you can continue to see losses in the funding ratio. So if you're at 100 going into July, you might be at 96% or so right now, but that this could continue to fall at a noticeable rate. And also, now I'll talk a little bit. First of all, any questions on what you just saw on the first 3 slides? That's a little bit of a background of where we've been. Now I'm going to do a few slides on kind of where we are right now, and then kind of looking forward. So I wanted to pause and see if there's any questions.
Actually, I mean, I have one question, Salil. I know
Sure.
we're like, because I saw this graph before, and I keep looking at it. It's like, I kind of surmised that the leverage effect has a massive, like, that if you see on the left hand side our drop in funded ratio versus the drop in a 75-25 portfolio is
Relative to 7% because of the leverage effect. Yeah,
right. Like
it's a
it doesn't.
combination of the
Okay, no, go ahead. But yeah, you're anticipating my question, but go ahead.
No, I mean, so that's right. So it's at a certain leverage threshold plus the TDA, and so it is. But even if one didn't have that, it is still at around the 6 to 8% level that these two match up. So you would have to have very large increases in asset returns above 7% in order to see substantial upward changes in the funding ratio. Now, this is all things equal. There's obviously closed form actual modeling that can go into this and other sort of assumption changes, but all else equal, a large portion of the explanation for the funding ratio change will be sort of how well you do relative to a certain threshold. And to the degree that we're going to get double-digit, and we have seen a double-digit loss in asset returns, but even if you get what I'll talk about later as say a lost regime going forward where you're 1% or lower, you will still see a drop in your funding ratio.
All right, thank you.
Any other questions?
I've got one after Russell.
Okay.
Yeah, no, this is a fascinating chart. I think
Thank you.
in general, the blue dots, if you were to apply a fitted line to them in general, is there going to be a positive correlation with that? Like, my understanding is that BERS's funded ratio has improved, generally speaking, over time, but then when you look at the dispersion of the blue dots during the down periods, during the bear markets, and they're much longer on the y-axis downward than the ones on the top side of the axis. So is there like a positive correlation if you were to fit a line to this? I'm curious to hear you comment on that.
Yeah, it's roughly a 60 to 70% correlation. The other 30% that would explain the gap, so to speak, the difference between the dots and the line, would be just tightening up. See, right now I used a rough proxy, 75-25. I could fit that more. I could fit more on other aspects of the funding ratio changes, timing effects, and also keep in mind there have been actuarial changes throughout this period,
and
also
market
the
resets
TDA.
as well.
Yeah, so but
Yep.
it is but by and large, not just for our pension fund, but for institutional funds nationally, a large portion of the changes after you account for what's happened since the global financial crisis, where there's been a more conservative set of changes to actuarial models, has been just these large and sustained changes to asset returns that would drive almost all of the remaining explanatory power of the changes in the funding ratio.
Go ahead, Sandy.
Yeah.
Yeah, so my question is both to Salil and to Siegel, and we talk about this a lot. The capital asset pricing model suggests that we've had 2 decades of anomaly of lower return for what should have been higher return. We've seen greater volatility where we expected, and we've seen more correlation, which suggests international allocations are significantly overrated as diversifiers or provider of excess returns. What are the, I mean, we have our own developing thoughts. I'm interested in what Siegel thinks about this.
So we don't have a view per se that non-US markets are not going to return over the long term in line with our assumptions. I think that when we look at non-US markets, yes, right now you're looking at an environment where it is a lot more depressed than in the US. So there is possibility of recovery. Is it going to be a longer time period for that recovery? Yes. We still believe that the non-US market will be a diversifier in a portfolio. Depending on how you invest from a portfolio construction, there is, I think, the ability of doing it having some passive in it for that beta exposure and adding a little bit of active also in the allocation. But we don't think that non-US is not going to be returning what we think our assumptions are going to be.
So just like to follow up on that, because so we've had 2 decades of actual performance deviating substantially from what the model would suggest should be. And if we ignore that reality, it seems to me we ought to be able to explain why that 2-decade period exists. I can tell you that my conclusion is that the model does not capture fully the risks we are taking in our international exposure. So, to be brutal, I think we should dramatically reduce our international exposure. And unless someone can explain to me why the models don't work and didn't work for the last 2 decades, the models are not all that valuable. And so, how do you explain the last 2 decades? I guess that's the question. And because I can't figure it out.
And perhaps just a comment on specifically looking at the most recent decade, you look at the relative underperformance of the MSCI EP sector as being represented developed market overseas exposure. Look at the relative performance, about 3.2% of that relative underperformance on an annualized basis comes from currency impact. Over the long term, the general thesis around developed market currencies is that they're operating within some kind of relative equilibrium. At this stage, the dollar is particularly strong. To anticipate that the next decade is going to have that same degree of strong dollar outperformance, would be quite concerning basically for every other developed market economy, that they're going to continue to get weaker at that same rate. But there are other options in terms of how you could potentially deal with that risk, kind of disentangling the currency almost as an independent variable that you could de-risk essentially by appointing a dedicated currency overlay manager that would disentangle that, and in effect turns a source of, as we're essentially just talking about, was a source of risk without much long-term return, and it actually has been a negative return over the last decade, could potentially be turned into a source of additional return for the plan. In terms of the case for investing in overseas equities, clearly a lot of other developed markets just have structurally lower GDP growth than the US. and I think that's been what's really underpinned our preference for active management over passive management in that space. In that, given the choice between passive exposure to the US or overseas, we'd probably go for passive exposure to the US. But given the option of active exposure to overseas companies within certain industries and sectors, we believe there are world-class countries that are located outside of the US that potentially derive a lot of revenue from a US customer base also. And it is potentially advantageous to be able to gain some kind of exposure to those. And to just address your final point around perhaps the benefit of diversification that has been lacking in recent years, I think just from a qualitative perspective, we would observe we have gone through an extended period of globalization, and certainly in the last 12 to 18 months, that seems to have come to a halt, or at least very much slowed the pace. And most of the managers and market participants we talk about are really thinking about the theme of re-onshoring or localizing supply chains, and that may contribute to an increase in the benefits of diversification across geographies, because it's likely to disentangle specific countries and regions of the world that may benefit to a great degree from some of those policies on a qualitative basis.
Okay.
Thanks, Ben. Yeah.
Sandy, if you're good, I'll keep moving.
Yeah, thanks.
Okay, no problem. So let me just kind of go through some of the remaining slides. So now this is for developed markets. There are 20 managers on the finalist list for developed markets from BAM. So looking at those 20 managers, and 14 are large cap, 6 are small cap. In blue, I show the large cap. I just averaged them together I show a separation on the next slide. And in red, I show the small cap managers. This is the last 10 years of their performance. I have 4 time regimes. First is essentially the first 7 years of the last 10 years. So 2012 through 2019. Then you have essentially the first year of COVID, so 2020, then 2021 is time T, and then the last 1 year. What you see, so for, I'll start with red, for small cap, is that the excess return on a monthly basis for the small cap managers that were selected in the finalist list for us to choose from, and in fact, one of them we essentially have in the portfolio right now, has been roughly 0.2%. And it's been fairly stable growing. I have no quibbles with that. The issue is on the large cap side, where it was 0.1 or so percent. By the way, this is gross excess returns. The machine learning model, which I use to identify even these time periods generally, would have said that in the COVID year, when the excess returns then blew off for that 1 year, was the time to be cautious. Then in last year, all of the excess returns month after month went to 0. So there was none. Then you're paying management fees on top of that. Then we saw what happened over the last 1 year. -1% loss against a benchmark that was already going down each month, not per year, not a 1% risk by taking this active manager. And these aren't just the 10 that were selected. Sorry, these were not the 14 large cap active managers that are kind of finalists from a survivorship basis. One of those of the 14 is actually fitting this perfectly and is already in our portfolio. Bailey Gifford Growth, which has still survived somehow and is a finalist again for continuity. If you look at this and just do what's shown as what happened cumulatively to all this excess performance, the large caps did outperform cumulatively over the last 10 years as you start working your way 10 years ago through time. However, almost all of that excess performance has vanished in the last 1 year and is at a real risk of going negative. And it's not just a story of the growth managers in large cap, it's just large cap, even the core managers, or we separate out the value managers. The way I look at these excess returns in terms of, do they have the qualities that you would want to have a set of them to justify that versus indexing? Do you have low dispersion, high correlation? Things like that just doesn't exist there the way it does. Now, Sandy had recommended looking at something called semi-variance. And so I'll just quickly talk about that. I could use that in the future in terms of asset allocation and CAPM. But that just says, instead of looking at regular variance or standard deviation, which looks at oscillations up and down from the average, semi-variance just looks at oscillations or changes, gyrations, whatever you want to call it, that are below average in any given time period. So this is over the last 8.5 years, covers the recent period down, but it's consistent for all of this. You see that for global equities, the standard deviation is around 14, but when you look at semi-variance, it's a little bit higher, 18%, and that's supposed to capture a little bit of what could be extreme or large downward changes that wouldn't be identified in, say, a normal distribution. What you see down here with Bailey Gifford growth is such a large drop when they do lose money that their semi-variance is actually a little bit less than the regular variance. I use standard deviation, that's the square root of the variance. But this 32, 31 is twice the levels you're seeing for US equities or domestic market equities. Let me keep going to some other slides here. This is showing the long history of the rate of return assumptions. You can see that they've been falling over time. This is sorry, on the left. Here I show what are the real returns for our asset portfolio. It gyrates around. Basically, the trend is, this is the the 10-year returns. So as the 10-year returns historically it's moved up and down. You've noticed these periods of like lost decades and so forth over like a 10-year horizon. But as the long-term average returns have kind of moved down, the rate of returns have moved down as well to sort of keep up with it. And it's a admission that in general, we've just been in a world that continues over the last 20 years to evidence slowly trending downward rate of return, and one that has to match the underlying reality that those trends move down, and also has the potential to see large drops or long periods of essentially this lost regime sort of concept, which I'll talk about a little bit later. And then one more slide to show kind of where we are right now. If you go back 3 years ago, these were our cash flows on the upper left. You see the outflows in the dark line, you see the in the dotted line, what are the inflows? And you see that wedge. The inflows is essentially kind of looking at how do you net out our contributions relative to the payments for operations, benefits, things like that. There was always this wedge, always this net cash flow negative. But in 2022, with modifications to contribution levels and this cliff, it's gotten even larger. And so to make up for that, you have to assume that you're going to get returns on assets to take as your investment returns and then help bridge this gap in cash flows. So I've used two stochastic simulations here. The first is at 5.5%. And when you do that, you can't deterministically just assume you're going to get 5.5% every year. You have to know that there's that uncertainty around all the different assets that we've been talking about and what can happen year after year. So this is just the inner quartile range, very similar to things you'll see in other places. The middle 50% of scenarios. You could have something where your $8 billion portfolio today might equal, in a median case, 12 billion by 2035. So it can jump 50% over 13 years if you're at 5.5% in the end. However, there's always a chance you can, a 25% chance you can be below this value here. And this value here is 7 billion. So there's a chance that to cover this $4 billion shortfall cumulatively, you might, instead of being able to be at 12 billion, you might have an additional 5 billion if you don't, if you wind up in the bottom quartile of this 5.5% assumption. What if your assumed rate is actually a little bit less than that? Let's say it's 3.5%, and it's very easy to get from 5.5 to 3.5. You have management fees, you have differences in return assumptions, other chances in terms of risks that can come along. Well, then you'd be in this sort of distribution here, and you'd be looking at essentially going from a $8 billion portfolio to roughly 10 billion, and you can potentially have an additional 1 billion down versus what I had here. So, you know, it's a lot of risk to sort of keep in mind. It's tempting to only look at a specific value that you assume, the middle case, say 5.5 relative to your liabilities, but you should look at the full range that we appreciate the uncertainty on the liabilities. I'm just going to go in the interest of, I mean, I'm happy to take questions now, but also I'm at 30 minutes. So in the interest of time, I can rip through the last few slides first. It's up to you guys.
Go for it.
Go for it. Okay. So the last few slides is just kind of looking forward now. This is 150 years of stock market returns for 10 years. So what are the 10-year forward returns for the stock market going back in time, and just showing all of it? And you can see that you have this sort of average here around 8 or so, and you have these periods that can be identified as, say, positive regimes, where you had very high returns on average each year for 10 years. You've also had what I'll call transitionary regimes, and then you have these periods which I'll call lost regimes. And one thing you'll notice is that it follows a true sort of regime switching mechanism. In other words, when you go from a positive return regime into a transitionary regime, which we already have, if you look at the most recent data, the Case-Shiller data, Professor Schiller's data that provides this information, the only reason it's not been updated the last couple of months is because the dividend data has not been put in, but we know what the dividend data is, so you could you know it's coming, it's going to be yellow. Once it hits the yellow period, you stay in that period for a while and you don't go back to green, you go into red. Every time you hit yellow from green, you go into red. You don't just swap around from green to red, back to green. That's why it's called transitionary. And so the reason I'm stating that is we're in this period right now where you can look at the numbers, and we're not in that scenario where you can just say that you're at a 6%, assumed rate of return on equities going forward. You sort of have to conditionalize it based on the fact that if you assume that you're in this bottom end here, you have, say, a 40% chance of being just between 0 and 6%, and maybe a 30% chance of being below 1% over the next 10 years. And let me show a little bit of this in a more heuristic way. Anyone who says that we have a 6% rate of return over the next 10 years in stocks, and at the same time says that the standard deviation or uncertainty around that is 2.5%, is implying that there's an impossibly low 2% chance of having, say, a lost decade, something very low, like 1 or less. That's the only way this thing, all these numbers add up. But historically, over the last 150 years, if you didn't know anything else, you just kind of dropped in from Mars and you just didn't know where you are in the economy, at any given point in time, there's always been a 5 to 10% chance of a lost decade, not 2%. And most surveys right now are closer to 15 to 30%. So if you work it backwards and say, well, if you want to assume that there's a 15 or higher percent probability, you have to shift that entire curve over, keeping that 2.5% standard deviation curve. And it implies through backward induction here that you have a 3.5% rate of return on stocks. That's the only way the numbers compute. You can't have the kind of the best of everything. And one more slide. I'll call this concept convexity drip. So a lost decade implies that you wind up, let's say use the definition that you wind up exactly in 10 years where you are today in any sort of profile. If you have a boat, you pay $1 million for it, you expect that it'll be worth $1 million in 10 years. It's completely lost for 10 years. If anything goes down 10% in 1 year, then you go from $1 million to 900,000. If you go back up 10%, you didn't get your 1 million again, you got 990,000, because arithmetically you drain versus what you expect compoundedly. So anytime you go down, say 20% in the market, you have to go up not 20%, but 25% to get back even. And that seems kind of obvious in some respects, but there's many ways to have to do that besides just at the top line, and that's because of this effect of leverage. So if you have the S&P go down 20% and it has to go up 25%, but you didn't invest in the S&P, you invested in a high beta leverage something or the other that's 2 to 1 essentially on the S&P, and it goes down 40%, that doesn't mean you now have to get 50%, 25% times 2. You have to get actually 67% in order to get up to where you are. Another way to think about this is if you have a portfolio that winds up at exactly the same spot, or an index that winds up at the same spot 10 years down the road, but you dollar cost average your way through. Instead of putting $8 billion in the market today, you put essentially $1 billion each year for the next 10 years. So you dollar cost average your way in, you wind up at a different spot than just having it all up front. So this idea that, well, it's okay to see this gyration in the market because you'll dollar cost average and wind up at the same spot is not true. You actually take risk along that process as well. We see that in other ways in the portfolio. We see it through the TDA. We see it through whether it's fund selection, through just the expected return when you have stochastic tail risk and other things. So the highlights, I won't spend too much time on this because it'll just be a regurgitation of what I described, but and just an appreciation in general that anytime there's uncertainty, there's things like opportunity cost and errors in forecasting that should be appreciated, and things that are often implied and hidden in theoretical models and in investment models, which don't necessarily get articulated to you the way they perhaps should, so that you appreciate the full range of risk in the decision that you're making. And that something that's important I'll mention here is that sometimes it's just as important to ask the question, what happens if your risk-adjusted return never occurs, as it is to ask the more popular question, which is how can we achieve, a higher risk-adjusted return? How can we achieve something better for the same or less? I mean, because you have to ask both sides of that. And basically just having a humility in sort of how you sort of structure portfolios, knowing that you then have to deal with the financial as well as psychological ramifications as things unfold, perhaps less favorably as maybe you see at times. So I'll stop there. I appreciate everyone's time. If there's questions, I'm happy to answer them, but we are a little bit over time too.
Any questions or comments for Salil?
Yeah, Salil, I have one question on a graph that you showed with cash flows a couple slides back, if you wouldn't mind going back to that one. Yeah. So the bottom left one, I'm just curious, is there like an assumed annual rate of return that is generating that declining dotted line of 2022 inflow?
Yeah, I mean, this is assuming zero, assuming that this is just the cash flows excluding. So this is just your contributions minus operating expenses as well as benefit payments. There's no, this is just the amount of, I'd say just the operational net.
Right. So assuming there are no increases or decreases in assets or liabilities, just if it were sustaining the existing corpus.
No.
No.
As it progresses.
Yeah. So Sandy, so Weston, I don't anticipate this question because yes, you're right. Obviously, at some point there's a stabilizer, right? The stabilizer is the city gets to kick in more money, right? Like that. If we had the work, so this assumes this is from the actuary's office. This assumes our standard return, what the cash flows will look like. But an important caveat to that is that
that we won't necessarily meet the expected return every year.
But one of the things is that it's important about this is that the actual biggest driver of that decline is not has nothing to do with our rate of return, but has to do with the ending of several amortizations that started in the 2010s. So most notably, when we dropped from 8.25 to 7, kicked up a ton of cash flows for us a while. So we actually have more. We're still putting in more money than we otherwise would have given our asset base, right? Because those amortizations, that big amortization, along with a few others, as Salil mentioned, there've been a ton of changes in kind of actuarial assumptions that have gotten smoothed over. At some point, right? Like so you might see a bit of an uplift. Certainly with the it takes time for the uplift because of the smoothing. So you see a bit of an uplift given if we enter this kind of loss regime, but not as big of an uplift as we otherwise would have. There are some solutions to that, right? Like you could somebody could reset some of the bases. I think you could to uplift that a bit in the out years. But your point being that at some point it's going to break, right? Like this, if we're in a loss regime, that number gets larger because over the 6-year time period we didn't meet the 7%. So
right.
That's absolutely 100% true. I think the cash flow, because the cash flows in the out years are lower than they are. Because let me rephrase it. Because the amortizations had artificially increased, increased the contributions from the city more than they otherwise would have been. You see this massive cliff in 2033. That again, if you reset the basis, there's a few ways that you could do it to increase it even more than you otherwise would have with a loss regime or a sustained period of underperformance or bad performance in our core assets.
I guess maybe the point that I'm trying to make is that this slide in orange in the bottom left is not necessarily consistent with the market performance slide shown a few slides subsequently to this, where it projects that we're going to have sustained returns declining over the next 10 years as we move through the business cycle.
Yeah, that's generally true. This is like a 3-dimensional problem to think about over the next 10 years, Russ. You've got the variability in returns, right? Because that chart does not assume variability in returns. So layer that on
Right.
top of
Right.
cash flow declines and the leverage built, the structural leverage built into our system as a result of the TDA. And then, one of the reasons we want people to be thinking about this and focused on it is that it is distinctly possible that the basket clause legislation is signed, and it may be one of the most dangerous things we can consider to go more illiquid in our portfolios. Because this
Right.
points
From a
to
cash flow perspective.
exactly, but that's really what do members worry about? It's not whether we get our returns. It's not whether the taxpayer funds the plan. It's is the cash there? And it's the same thing we have to consider when we make a 5 to 10 year commitment to a PE fund or a venture capital fund. Is the cash going to be there, or are we going to be forced to sell? And you have to think about this over the next 10 years, which is why, today is a lot less important than what the risks are 5 to 10 years out. And this is an extraordinarily important concept to grab a hold of and think about, because like I said, it's three-dimensional. If you're not looking in all three directions, one of these things might take your head off.
So the stochastic modeling is path dependent in this case, like any of these are. So when I say there's a 25% chance you wind up at the lower end here at 2035, 25% chance you wind up there, but a 30% chance you wind up somewhere before that at any part along the way. So that's something else to keep in mind. You can get to that endpoint a lot sooner, earlier. These are very high probabilities.
These are all probabilistic models, of course.
The same one, almost anyone would use in any regulatory environment. Yeah. And the same ones you're making the investment decisions off of as well. Like
Understood.
an example of that is that you have a 5% standard deviation around your 10-year U.S. equities return, even though it's maybe 70% any given year. Over 10 years, it's say 5%. So yeah, it's yeah.
No, I can appreciate that. I guess I'm trying to make sure that I'm grasping some of the implied takeaways from this presentation. To me, it sounds like you're potentially suggesting that during an asset allocation exercise that capital expectations for performance should probably be lower than they have been in the past. Would you say that that's an accurate characterization?
Yeah, so yeah, the returns should be lower. The risk should be higher. The covariances might need to be tightened up. Things including the cyclical nature of how these returns can pop up. So over the next 10 years, I don't know if anyone can really say that there's not going to be just one recession or one
Right.
downturn.
Right.
Could be two, and that could be a massive difference in kind of where you wind up 10 years down the road. So yeah, so those are definitely the things. When I've been running the simulations, I've been running extraordinary amount of simulations that try to take into account all of those nuances, and they're important because if there's a suggestion anywhere from how do we deal with the basket clause or something more nuanced with how do we try to optimize around ESG, diversity, managers, and all of that, every time you make a tweak, it has to come from somewhere, and trying to figure out what risk am I taking in order to kind of thread the needle on all of these risks and get the type of return that you want.
Sure.
It involves many more simulations.
Got it. And there's one more point I just want to ask before I turn it over to see if there's any other comments or questions from the rest of the group. But the asset allocation exercises that we typically undertake with the general consultant, they typically do incorporate some aspect of cash flow modeling into the asset allocation decision. Is that accurate to say?
That is not clear to us.
No, the ALM. So the ALM study did. The ALM study
pardon
did.
me, I'm
So that
mixing the two.
Yeah, so the ALM study did. And so when we worked with Siegel and the actuary's office does take into account. And
they don't take account cash flows, and they just take into account the current liability.
Oh yeah, that was like. But you know, the takeaway there was right, and I think this is certainly multi-layered, but the takeaway there was that, you know, at the time was get to your target, right, and that the target asset allocation had a better risk return profile given our liabilities than where we currently were, and so that aggressively getting to target was was like the big decision. So if we think about the takeaway
Right.
from all of Salil's analysis, I think, right, and obviously, you know, he could, you know, speak for himself here, but I think that the single biggest, I think we have two huge decisions to make. One is what does our equity portfolio look like, right? I think certainly talking about that international portfolio, especially given that it takes up basket clause room, right? Like, you know, the single biggest, I mean, like after private equity, right? The single biggest contributor to our basket clause room is international stocks, right? Because our real estate really takes up no room because we haven't hit the 10% limit yet. So after private equity, international stocks takes up that precious room. So, and it's been disappointing. Maybe it will be, maybe it won't be going forward. But understanding and how the shape of our equity portfolio, I think is the single biggest decision. Part of me says, listen, we just got to take this, right? Like I'm not trying to be, you know, we're not particularly nimble organizations, right? Like part of me says that we have to live as the oak tree, and does that mean that there's more contributions? One thing we've been talking about is can we layer on some aspect of the city budget and thinking about triggers to pension contributions for a new tier, for instance, right? Like that's if we're thinking about the risks to city balance sheet, risks to new members, which I think are the two biggest like kind of risks to the plan. You know, obviously that flows through market risk, but how do like again, the answer might be just like, listen, we just got to hit the wave, right? And there's not much tinkering you can do except on the margins, right? And then does that mean again going more to U.S. equity? Does that mean going into more into real estate? That's why I think the decisions lie from the ultimate asset allocation perspective. But to Sandy's point, the leverage effect, like we have so much implied leverage into the portfolio that maybe levered equity like we don't need as much levered equity as the other systems, right? So that's something that I think all of those it's multivariate. It's mostly just preparing folks for this conversation, because I think I love like I commented on Salil, like slide 11 to me, kind of really told like if I had to say one thing, slide 11, this slide right here is the thing that I think is the most important as we're looking at the next 10 years.
And because we are, I mean, in fact, we are different than the other four systems. We are substantially better funded, but we're all substantially leveraged. I mean, it is last measurement 28% leverage when not marked to an economic value that makes sense. I mean, I think if you marked our leverage to market, we're probably 33 or 34% levered. And that is unbelievable economic leverage. There are no pension systems in this country that are leveraged like that. CalPERS is talking about going to 6% leverage and doing it slowly over a period of years.
So that's a lot. I know.
Yeah.
It's a lot. It's a lot. But
A lot to think about.
I think it's a lot to think about. Certainly, you know, the basket clause change is going to trigger an asset allocation. Glad we have Salil here to walk us through a lot of this information to incorporate it. So we've been talking with the Office of the Actuary about how we best integrate some of their information. And like I said, thinking about maybe even talking to OMB to do the same, because being at it, like the inflection points are really where you can, you know, kind of make or break yourself. Salil, thank you. Really appreciate
Thank you,
the
Salil.
update.
Tremendous value to us.
Thank you. Thank you. Let me close.
All right, so that is the last item for public session. We have one item for executive session to discuss an investment fund for consideration. May I have a motion to move into executive session?
So moved, Russ.
Thank you, Russ. Do I have a second?
You need a second?
Yes.
Second from me.
Thank you. Any further discussion? All those in favor, please say aye.
Aye.
Aye, Russ.
Any opposed? Any abstentions? The motion carries. We are now in executive session. Karen, can you pause the recording? Restart the recording.
Okay, the recording has resumed. You may proceed, Antonio.
Absolutely. To report out of executive session. In executive session, the committee approved a commitment to a private equity fund. That is the last item for our executive committee meeting. Just need a motion now to adjourn.
So moved, Russ.
Thank you, Russ. Second.
Second.
Thank you, Donald. Any final discussion? All right. All those in favor of adjourning, please say aye.
Aye, John.
Aye, Russ.
All right. We are adjourned. Our next meeting of the executive committee is Thursday, November 17th, 2022. Have a wonderful rest of your day.
Thanks, folks. Bye-bye.
Bye-bye, everyone.